Coca Cola is one of the best known brands and one of the biggest US blue chip companies in the world. Known to investors for its strong dividends, at first glance it should be a perfect fit into our portfolios at Money Unshackled, given that we crave dependable passive income.
But in recent years, Coke have struggled in a new world obsessed with health and ethics in a rocky world economy. Is Coke still worth investing in? Let's check it out. Welcome to Money Unshackled, the investment channel that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button and click subscribe. Also, check out some of the links in the description below where you can get up to £100 cashback bonus when you sign up to one of the peer-to-peer platforms. Let's get into it.
Why we like blue chip dividend stocks. Blue chip stocks get their moniker from a game of poker, where traditionally the blue chips hold the highest value. In the stock market, blue chip companies are the biggest, most established global companies and tend to offer their investors dependable dividends in place of fast growth. You're never going to get rich overnight with blue chip stocks, as they are already past their main growth stage. But our portfolios benefit from a solid foundation of these dependable stocks, which provide steady cash flow to support our lifestyles.
Dependable dividends. This is what we mean by dependable. Dividend investors have seen big rewards from holding Coca Cola stock with more than 50 years of consistent, reliable dividend growth. The current annualized dividend payout is forecast at $1.60 for 2019 and pays quarterly, with 40 cents already paid in March 2019. The current dividend yield is 3.38%, which is around what it has been historically. A company cannot control its yield percentage as it cannot control its share price, so the consistent dollar returns are what we look for in a historical analysis.
But as investors, we also like to know what our current rate of return will be if we buy the share, and 3.38% is okay if we can also achieve some capital growth on top.
Stock price. A mid-range dividend means we also crave capital growth to sweeten the deal. Here's Coke's recent stock price history. We primarily care about the last several years when looking at stock price, as it's the best indicator of current performance, but even this is highly imperfect as an indicator of future performance.
The best we can take from looking at the share price history is that Coca-Cola's share price has been steadily growing at a consistent rate, with regular peaks and troughs. This gives us some confidence that Coke will continue to experience price growth to supplement our gains from dividends. The low volatility gives you that extra piece of comfort that may help you sleep at night.
Price-earnings ratio. Coca-Cola had a price-earnings ratio of 31 at March 2019. The price-earnings ratio is calculated as share price divided by earnings per share. So the higher the share price relative to earnings, the higher the price-earnings ratio. Likewise, if earnings per share reduced, the PE ratio would increase. This is what happened in late 2017, early 2018, when we saw a spike in PE ratio due to a one-time charge of $3.6 billion related to the repatriation of overseas earnings following the Tax Reform Act in the US, temporarily hurting Coca-Cola's net earnings, which fell by 81%.
The price-earnings ratio has now settled back down to around the 30 mark, where historically it had been around 20. This higher PE ratio of 31 compared to the history could mean that Coca-Cola stocks are now overpriced compared to the value that you could attain pre-2017.
But how does Coca-Cola's price-earnings ratio compare to other companies? Well, the price-earnings ratio of the US beverage industry comes in at an average of 27 and the market is 18. This suggests that Coca-Cola is overpriced when compared to the industry and the market.
Soft factors. There are many soft factors that we must consider when considering the future potential performance of a stock. The financial metrics we have just looked at are historical, not current, and definitely not future. Rather, they only hint at how capable the company has been up until now. Here's 5 soft factors we should consider alongside the numbers.
Number 1. Endorsed by the wallet. A good endorsement of a stock is whether the investment gurus actually put their money where their mouth is and buy it. Warren Buffett is the biggest guru of them all and holds significant shares in Coca-Cola. We could all do a lot worse than following Warren Buffett, and this endorsement by the wallet is a check in Coke's favour.
Number 2, brand power. Coca-Cola has been around for more than a century and its brand has endured the test of time. It consistently tops the list of world's most recognised brands and is part of the everyday lives of billions of people worldwide. This supports the theory that Coca Cola is a stable business but will continue to deliver dividends to its shareholders. And its everyday use by billions of people makes Coke a safe haven during market downturns.
Number 3, competition. Coke doesn't have to worry too much about competition. It is by far the market leader in the carbonated beverage market, and its customers are very loyal. Coke are masters of marketing, with commercials that show Coke as being part of everyday life. We all have a preference between Coke and Pepsi, and given the choice, we'll stick faithfully to our drink of choice. Does this scenario sound familiar? You're in a restaurant or a bar and you order a Coke, and the barmaid says, "Is Pepsi okay?"
This just goes to show that the word Coke, or Coca Cola, is now common parlance for anything that is brown and fizzy.
Coke is a global company that dominates the market in many developing nations, but there is still opportunity to grow in some countries.
Number 4. Sugar, the 21st century bogeyman. The world is waking up to the fact that sugar has direct links to obesity and type 2 diabetes, and governments are starting to take action against companies with products that contain significant amounts of the stuff, products like Coke.
In the UK, the sugar tax has artificially inflated the price of a bottle of Coke more than what it ordinarily would be set by the market. Perhaps not significantly enough to make them unaffordable, but it certainly has made the public aware of how unhealthy sugar products are. One thing to consider is tobacco taxes. They originally came in at a low level, but have steadily increased over the years, making tobacco products very expensive. The same could happen to sugar products. Whilst the sugar tax is UK specific at the moment, it's very likely to spread across the world.
Luckily for Coca Cola, it doesn't just have one product. Of its 3 main products, Diet Coke and Coke Zero are seen as popular alternatives to the original full sugar Coca Cola. In fact, in the UK, Coke Zero is now more popular in terms of sales than original Coke. We think that Coca Cola's alternative low sugar range and its diversification into non-cola products, such as the purchase of Costa Coffee in the UK, will allow them to weather this storm, but focus on health is a factor that will continue to be an ongoing issue.
Number 5, environmental concerns. One factor to keep on your radar is environmental and green regulations that will likely come further down the line. As investors, we buy for the long term. And the world's renewed focus on plastic and other waste could mean that in the next decade there will be crackdowns on products with single-use containers like those sold by Coca Cola. As a producer of billions of bottles and cans, Coke is indirectly one of the main contributors to litter in the environment, and we would expect Coke to be among the companies first on the firing line if world governments decide to act. We would expect the company to survive, but we would also expect the share price to take a beating in this scenario.
Should I buy that stock? In summary, we believe that Coca Cola is a decent asset to hold in your investment portfolio. Its dependable dividend, its steady increase in share price, and its strong brand and customer base make it a decent cash flow asset. But its yield is not that great, and its future is littered with potential pitfalls as the environmental and health lobbies gain ground in the US and worldwide. Also, its PE ratio gave us cause for concern, as we thought that it may be overpriced compared to other players in the market.
There are better dividend stocks out there, and if your portfolio is small and your investable cash is limited, then you might be better suited to invest that cash elsewhere. We have 2 very popular videos covering 10 of the best UK dividend stocks, and we've put the links in the description below, so check those out.
Question of the day: do you hold Coca Cola stock in your portfolio, and how do you rate its performance? Tell us in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is Money Unshackled. See you next time.